Dismal numbers from all sectors of the U.S. economy have made this a summer to forget. Continued weakness in the labor market, a slowdown in manufacturing, and the worst housing data in years. But through it all, the stock market has retained its value. Will that trend continue? Or will investors finally pick up on the signals that the economy is sending? This week on Money and Markets, our guests tackle that question and more. Monty Agrawal tells us how institutional investors are setting their strategies for the market. Rudy Martin looks outside the U.S. and focuses on one region promising outsized returns. And Larry Edelson gives us his forecast for commodities. Plus, two money managers discuss what they're seeing in the markets and the economy every day. All that and a final comment from Martin Weiss coming up right now.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. Labor Day is right around the corner, and that means more activity in the markets. But which direction are those markets likely to move, and what's going to move them? Joining us to answer those questions is Monty Agrawal. He is the managing partner of MACM and the editor of the Rapid Growth Portfolio newsletter. Hello, Monty.
Hi, Jamie. How are you?
I'm all right. Monty, what data are you looking at right now, and what is it telling you?
Well, Jamie, all the recent data that has come out has been quite poor, actually. Whether you look at the employment report, the manufacturing activity, the durable goods orders, etc., that data, unfortunately, has been pointing to a very anemic recovery in the economy. Now, obviously, as the market starts to trade on the basis of the economic news coming out, the numbers do not portray a very healthy picture, and I actually expect the markets to turn south in a very big way.
Okay, as traders are going to get back from their summer vacations, what are they going to be focusing on when they return?
Well, obviously, we see that the traders take vacations. August has always been a very big vacation month, so the volatility tends to dry up. But this year, for some reason, the volatility has been very poor. The volatility has been very bad because the liquidity has been very poor. Now, the first thing they're going to look at is the jobs report that comes out tomorrow, actually. And that jobs report is going to define the way the market trades over the next couple of months, that is, until the next big event, which are the November midterm elections.
One thing that we've seen a lot of in the newspapers is M&A activity. Seems to be all over the headlines, major companies like HP and Dell. What do you think its impact on the economy is going to be?
That's a good question. That has obviously been the big trend in the markets over the past few weeks, which is a pickup in merger activity and takeover activity. Now, what is happening is, first thing that what that means to me is that companies are sitting on a lot of idle cash. Now, the reason they're sitting on a lot of idle cash is because they do not want to take the risk in investing in businesses for organic growth. They find that it is way more profitable for them to acquire businesses with established revenue streams and look for profitability by cutting costs. And the way they're going to cut costs, unfortunately, is by laying off people, combining operations.
Okay, so things looking pretty grim out there in the job market again. How would you be telling investors to play the market from this point forward?
Well, number one, watch the economic and the corporate news coming out. That is very, very important because the market is very jittery and the market is trading on literally every piece of news that comes out. It's very hard to find trends right now, but as I mentioned earlier, that once the traders return from vacation post-Labor Day, the market will define a trend. The volatility will stay, but there'll be more of a trend in the markets.
All right, Monty Agrawal, thanks so much for being here.
Thank you.
The economy will likely determine the direction of the U.S. markets, but outside our borders, it may be a very different story. Joining us with an outlook for the international markets is Rudy Martin. He is the editor of the Latin Stock Investing newsletter. Hello, Rudy.
Hello.
Rudy, what is the major global theme that you see developing over the next 4 months?
Well, emerging markets means emerging consumers. Basically, we've seen the first wave of growth coming from exporting natural resources. And now those natural resources have had a benefit in the economy, and you're seeing the consumers actually starting to purchase goods and drive the economies that way. So I think that, we've seen that trend in places like Turkey and Indonesia recently, but I'm seeing it very clearly in Latin America.
Stock markets there, they've outperformed the Dow by about 10 to 1 recently. Now, why do you think that type of performance is likely to continue?
Well, you know, it's not just natural resources. You're seeing a lot of happening in the industrial production area. For instance, the Brazilian airline manufacturer, aircraft manufacturer, Embraer, their back orders are up about 17 billion. That represents about 3 years of annual sales. That's a huge increase for them. And we're also seeing other opportunities for investing in smaller industrial companies throughout Latin America as well.
Well, most of these emerging economies, they've grown because of their exports. That seems to be changing now. Now, where do you see this change happening the fastest?
Well, I talked a little bit about Brazil, and I don't want to keep beating that drum too much because more people are getting comfortable with that. But I am seeing, for instance, opportunities in Argentina. Every time I put an Argentine stock into my portfolio, there's a surge. I put in the internet stock in there, and the stock was up 26% year to date versus 4% in the market. That's a 30% difference. That's a big difference. You know, let's talk about Chile. You know, they've got about $8 billion in stimulus in their economy. We mentioned that before, and that's flowing through into the banking sector as well. You've got investment opportunities in Peru. There's some natural resources plays there that are interesting, and some other industrial plays there as well. And as well as Colombia, which is a market that just really is starting to get off the ground in many ways. And finally, the one that I think has got the most interesting long-term potential is actually Panama. It's going to be the Hong Kong of the next decade, and really something to be watching.
I think the big question here in the States is how can American investors play this trend?
Well, you've got a point there. Some people are uncomfortable about buying Latin American stocks or Latin companies, but you don't have to go that far. You can buy Maytag. They export washing machines to Brazil. That's a very popular item there. Coach, sells in emerging markets, and they're seeing growth there as well. And even something as simple as Coca-Cola, which is growing internationally, and it's doing a transaction to increase its shares in its bottlers, which makes for interesting opportunities there as well.
Okay, what is the one thing that viewers should know about these emerging economies?
Well, you've got a situation where you've got the emerging consumer basically driving the market, and you can sit and get worried about the U.S. budget deficit and 1% interest rates, but you've got some high-yielding industrial and utility plays throughout Latin America that are producing great value, and that's something to look into.
All right, Rudy Martin, always a pleasure. Thank you, sir.
Thank you.
Many of those emerging markets that Rudy was just talking about have gotten to where they are because of commodities. So let's take a closer look now at the commodities markets and find out how they're likely to perform over the next 4 months. Larry Edelson is a precious metals and commodities specialist for Weiss Research and the editor of the Real Wealth Report. Larry, what is your forecast for commodities through the end of this year?
Well, Jamie, I think first we have to separate gold from the other commodities. Gold will very likely continue to rise because it represents a safe haven investment. But in other commodities, I expect to see more of the type of selling we've seen over the past month or so. For instance, I expect to see additional selling in oil, in the agricultural commodities, in silver, platinum, palladium, and copper. That's because everyone's now finally coming around to our view that there is a serious double-dip recession in the U.S., and they're taking profits off the table and liquidating out of commodities.
Okay, do you think that represents long-term weakness in commodities, or do you think this is just a short-term trend?
Oh, it's definitely just a short-term trend. In fact, I think it's going to be a great buying opportunity for commodities. Chief reason, I have no doubt that Ben Bernanke and the Federal Reserve are going to start printing money hand over fist. Longer term, that's going to mean another wave of asset inflation. So investors taking a longer-term view should use these dips in prices to pick up commodities and commodity-related equity positions on the cheap over the next few months.
Okay, but does the Fed really have the power to change the course of events here?
No, they don't have the ability to stop the double-dip recession, but they do have the ability to deflate the currency and inflate asset prices. And I think that's exactly what they're going to do in this situation. Whether it's a double-dip recession or we end up in a depression, there are really two paths to get there. You can get there on the one hand through massive deflation, such as we saw during the Great Depression, or through hyperinflation, which is where I ultimately see us going. It's kind of like fire and ice. They're two opposite ends of the spectrum, but they both can give you third-degree burns. So, it's even possible we could see a mix of continued deflation in real estate and financial assets and inflation in other assets.
Okay, so what do you tell investors to do in a situation that's shaping up to look like we see?
Well, I'll tell you what you shouldn't be doing. First, number one, don't buy Treasury bonds. The Fed is supporting that market, but ultimately the bond bubble is going to burst and Treasury prices are headed much lower. Plus, the dollar is likely to fall. So any minimal return you're going to get from Treasuries, 2.5%, could get wiped out very easily when the currency is depreciating. Also, I would reduce all holdings in the U.S. stock market in companies that are vulnerable to a double-dip recession, either service industries, consumer discretionary, and real estate and financials. These are going to get hit hard again during the slowdown in the economy.
Larry, individual investors are already starting to shift out of stocks and into safe haven investments, right? That's what you've been seeing.
And we're going to continue to see that. And that's why we've seen such a bull market in gold. Tangible assets are the best hedge against the Fed pumping trillions of dollars into the system. But it's not just gold. I mean, any upcoming dips you see in the prices of other precious metals or oil and natural resources, it's going to represent a good long-term buying opportunity. And you'll also find a lot of value in equities related to commodities, mining shares, and natural resource stocks.
Okay, Larry Edelson, always a pleasure. Thank you, sir.
Thank you, Jamie.
Coming up next, we'll give you some picks and pans in the stock market based on the analysis of all three of our guests. And later, a closer look at how money managers are putting these strategies into action. We'll be joined by Sebastian LeBurn of Weiss Capital Management and Anthony Pieri of United Bullion Group. If you want more information about our forecasts, or if you have a question or comment for any of our guests, just email us at weissmoneynetwork@weissinc.com. We're back in a moment.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
With risks on the rise, you need investment advice you can trust now more than ever before to help protect your wealth. At Weiss Capital Management, we've been managing money professionally for over 25 years and specialize in protecting your investments in turbulent times. Call now or visit our website to get our free special report, Global Credit Crisis Act 2, the steps you need to take now to help protect and potentially grow your investments.